Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
I think a big part of it, learning what you don't know and being able to figure out what you don't know. And I think that especially for visual minority communities, there's a bit more of a challenge there, because I think a lot of it, there was a pivot in my life. So my parents immigrated from Hong Kong in the 70s and they came to Canada. I'm born and raised in Toronto. And when I was young, I would get mentorship from my parents, and my parents would give me all this advice and tell me. And what my parents was able to do was help me figure out how to get a great job, how to get an income, how to get an education, how to get a degree, all these types of things. But then there came to a point where, and this is a struggle for a lot of people that become accredited investors that essentially amass $1 million. Their first million is really challenging to get to. It's probably the hardest million to make is the first million. But one of the things that I discovered is that when I'm coaching and advising millionaires, the first question I ask them is, are you the first in your family to get to this threshold? Because if you've now surpassed your parents in income generation and in collection of wealth, then as much as you love your parents, their advice is behind you now. And it took me forever to realize that. So if you're at a certain stage, take a look at where you're getting that advice from, because I spent and for our parents is really difficult, because especially in different communities, in the Asian community especially, we have this heavy emphasis about respecting your elders. But when it comes to finances, I've surpassed my parents. So how do I still show respect and love when my dad's trying to give me, investment advice? And I try to gently tell him, Dad, I've got 2 decades worth of Wall Street advice. I'm a licensed stockbroker for 20 years. It's you can't really teach me anything about how to be money wise, right?
Yeah.
So you have to be gentle with that. So the next phase to get to that is recognize, who do you want on your sort of personal board of directors, and are they qualified to be there? Because the people you want to get that advice from, are they where you want to end up, or are they where you used to be? So if everybody on your board of directors are your aunt, your cousin, and they haven't amassed as much wealth or success as you, why are they on your board of directors? It's you can still have a personal relationship with them, but when it comes to career advice or wealth building advice, they're probably not qualified anymore. So you've got to look for other people to mentor you. And if you can't physically find somebody that's there that you have connection with, then I started replacing it with books. And people that have done it, start with Rich Dad, Poor Dad, read all this other kind of material from people that are where you want to be, and use them as your board of directors until you can find great mentors and great coaches to help you.
And so what I came to really learn and study, and what I share with my clients and others when I speak, is helping them understand, how does money actually work? How does it really, really work? Because we understand what, Wall Street or the IRS or whoever it is wants us to understand, but we don't always have all the information to make the most informed decision when it comes to money. So here's an example of that, the 401k. So for most of us, especially if we're higher income earners, we are maxing out our 401k because we believe that we're going to get this tax benefit. And in fact, yes, you will get somewhat of a tax reduction in your current year taxes if you put your contributions in there on a pre-tax basis. But what we're not thinking about is all the time that our money is sitting in our 401k account, especially those pre-tax dollars, whether that's 10, 20, 30, 40, 50 years, that account is growing. And so your tax bill is growing. You're literally contributing to an uninterrupted compounding tax bill inside of your retirement plan. So at the time when you actually need to access that money, when you're no longer actively working, you're going to have to pay a much higher tax bill. And if you're in, I have a lot of clients in California, New York, and these high state or high tax states, when it comes time to actually take out that money out of your 401k, many people, when I run the numbers for them, they're going to realize that actually the balance that they have is probably, what they'll actually pocket is probably going to be 2/3 or maybe only a half of what they actually thought they were going to have. And it's shocking, but it's true. And so I try to help people understand, because no one ever talks to us about that. They just say, yeah, max it out so that you can save on the taxes today. But no one ever talks about what's the impact of doing that down the road when we actually need to pull out that money. So between fees and taxes, like I said, it literally for some people can be anywhere from 1/3 or half of their balance is gone. It's disappeared. So they've been working all those years and putting it away for all those years and being disciplined, but they only end up with half.
One of the big ones, is real estate, right? Like you can write that off. Any of those types of assets, most of the things that we're taught is to put it into tax deferred things where, you put in your 401k, your IRA, you're penalized if you touch it before a certain age, you got to pay taxes on it. A lot of people don't know that account grows and it falls, it goes up and down. And so you're kind of looking at that end number, thinking that's your number. Say you have $1 million in it, but at retirement, you still got a partner, taxes, you got to pay that. And so it's just being more efficient and knowing, I just want everybody to really see the power of how life insurance can work, because there's a lot of tax efficient strategies in that. There's a lot of compounding growth that you can have in it over time. And then there's the opportunity to use it perfect for real estate, borrow it from yourself instead of the bank. And one of the things that's really powerful about it is when you borrow from it, you don't lose. It's not like you actually took that money out. So that money's still there growing as if you never touched it. And that's what really makes it powerful too. So imagine you have a property and let's say it's $20,000 that you need to put down. So most people will borrow that from the bank, right? $20,000, get a loan, and you pay whatever. Now we're like 7.5% interest rate, which is crazy.
Like 8. I have a friend that's actually looking at mortgages, 30-year mortgages for a second home, and she's getting quoted over 8.
That's wild.
Yeah.
That's wild. Yeah. And, so if you can borrow against yourself, from yourself, and put that $20,000 down. And so let's say it's an investment property. As your tenants make that payment, you make the payment back to your life insurance policy, but it's still growing as if you never took the $20,000 out, on top of the interest that you're gaining from making the money from the tenants. So it's like getting your dollar to do the job of two things. And that's what most people's dollar do one thing, right? But if you can get it to do 1, 2, 3, 5 things, then you're just growing and building all over the place and not really depending on one source.
Yeah, it's slow.
I believe in the power of the and, not the tyranny of the or. So like, it's not you have to do this or that, but you can do them both at the same time, but like make sure you're being intentional. So for example, say I'm getting together with someone and they're like starting from scratch. They're completely starting from scratch. I'm gonna be like, hey, like we're gonna create this strategy for you. We're gonna have some of your money going towards your emergency fund. We're going to have some of your money going towards your investments. We're going to have some of your money, going towards, this future goal that you have. We're going to have some money going towards, protection, insurance pieces, things like that. And so we're like really creating this like strategy to say, hey, how can we like chip away at all of these different goals at the same time? Because you don't want to be like all offense or all defense. Like there's no team that has won with like an amazing offensive strategy, but no defense.
No defense.
And I'm not going to say like you could do it, but like like in building wealth, like there are outliers out there. There are absolutely outliers. There are people that have done it, like, doing like all offense, but like you really want to also reduce risk. And risks are also very apparent. And like, I believe like don't pay attention to the risk. Like don't focus on that. Like you don't want to focus, oh my God, this bad thing's gonna happen. I'm like, get in that negative mindset and you're just focusing all on the bad. But like you don't want to drive 100 miles down the highway without a seatbelt. Like you gotta be
okay, got it.
Aware of those risks.
Note well taken.
Yeah. And you may get to point B perfectly fine, but like if you hit one speed bump, it's over.
To build wealth with real estate? Are you all tapped out on YouTube University and ready to get help tailored to your specific situation and goals? Have you always known that you are a little different from the crowd, that you never liked following the status quo, and that you're just tired of living in mediocrity? You want to build wealth on your own terms outside of Wall Street? Well, then maybe the Microfamily Mavericks mentorship program can help with that. It's a community where I handhold you through the process of buying your first small commercial multifamily building, because not everyone is ready for 100 units out the gate. Why multifamily? Because it gives your rental income a hedge against vacancy. Imagine what happens when your single family rental tenant leaves, right? And why commercial 5+ units? Because you have much more control over increasing the building's value in the commercial space, and then in turn, increasing your own net worth. Starting small is a stepping stone to so much more, because then you can tap that equity and buy another building and another and another, and you get the point. So increasing your cash flow and your ability to be job optional along the way. It's all a part of the journey. So if you think big, but you want to start small, and if you know multifamily real estate is the way for you to open the door to building a life of freedom, abundance, and legacy, but you just need someone to guide you step by step, and you want to be surrounded by other people on the same journey, doing the same thing, then just click the link in the show notes to find out a little bit more about the Microfamily Mavericks, and I look forward to potentially seeing you on the inside. So now back to the show.
Stockbrokers, you would consider them like RIAs, so registered investment advisors, and their responsibility is to do wealth planning for somebody's entire wealth, including their 401ks, their IRAs, and investment accounts. And they're focused more on things like asset allocation and investing in public stocks. Now, in that arena, there's a small segment that you have for alternative investments. Now, alternative investments, in that category, you can have a section that's considered what we call private equity. So private equity is something that's not a publicly traded stock. So private equity means a private company. So what we end up doing is, so if somebody owns like a dry cleaners or somebody owns a business, that person technically is running a private company or private equity because they own the equity component. Real estate, you can invest it in the same way. So in real estate, you can invest it into a real estate income trust or a REIT. So if you buy it in a REIT, that is a public version of real estate. Or you could buy the same asset class without the public market and just create your own syndication in a group of individuals, and that would be considered a private equity. So that's a private equity arm inside the greater umbrella of wealth management. Now, as a side note, there's also a vertical called venture capitalist or VC. How VCs differ from private equity is the collateral. So in a VC, you'll have a lot of tech firms. So tech firms are a lot of ideas and innovators. But if you invest in that and the company fails, you can't foreclose on property. There's no bricks and wood there. So because there's no asset there, it's not considered a private equity. It's considered a venture capital. It's considered VC because there's very little collateral. The first collateral you could possibly get is IP, intellectual property, if they have patents, but that's about it. So it's a little higher return, or it's higher risk. And the multiples are higher than private equity, but private equity, you end up with more collateral or potential on the downside. Yeah. So my specialty was private equity as well as total wealth management because I was a licensed stockbroker as well.
So most people are familiar with term life insurance. And the reason that term life insurance is so cheap or, affordable, but cheap is because it's usually for a term or a period of time, maybe 10 years, 20 years, 30 years. Typically, most people have life insurance up to say age, in their 50s or up into 60. And the reason that it's so cheap is because actuarially speaking, right, just based on real information, real data, it is so unlikely that a person will pass away in that time frame that the risk to the insurance company is so low that they're able to offer you that product for such a low amount of dollars. In actuality, less than 2% of all term life insurance policies actually pay out a death benefit. That's how likely it is for you to pass away.
2%?
In that time. Less than 2%.
Wow.
Okay. So I'm not saying that there isn't a use for it. There's definitely a use for it, right? And especially I still offer convertible term. Convertible term life insurance is where you hold this insurance for a period of time. And in that, let's say it's for a 20-year period. In that 20-year period, you're able to convert those dollars into whole life insurance over time, because maybe you can't afford all the insurance that you're entitled to right away, but we can at least get you insured for that amount using a term policy, a convertible term policy. And as your income grows over time, or your net worth, or you have other incomes coming in, we can then start to convert it from term into whole life. So you're able to start to build wealth in that way. But some people, all they can afford is term. So it's good. It's better to have some insurance than none. But with whole life insurance, you have this cash value component to it. Okay. Term life does not have this. Whole life insurance has this cash value component. I tell people to think of it as sort of the wallet of their whole life insurance policy. So the first job of life insurance, when you're paying those premiums, is to be able to replace your income upon death. That's what that death benefit is for. And the other key thing is that that death benefit goes to your loved ones income tax free. When you leave your loved ones an IRA or 401k, or most, even a bank account, most other vehicles, they're going to have to pay taxes on that money once they receive it, once they withdraw it themselves, right? So just
inheritance
receiving it. I'm just talking about just income tax. I'm not even talking about estate planning, anything like that. This is just income tax. So if you pass away and you still have, 500,000 in a 401k, when your loved ones, when they start to withdraw those monies, each time they take a withdrawal, they have to pay the taxes. Just like we talked about when you would take the taxes, they're going to have to pay the taxes on it. Okay. And that income that they take, it's going to be added on to their income. So it might push them into even higher tax bracket. So they're going to end up paying more taxes than you probably would have wanted, right? So it's like, are you really leaving your money to your loved ones or to Uncle Sam? But with a death benefit from a life insurance policy, it is going to your loved ones income tax free. Okay. So that's the first thing. That's the death benefit. That's the insurance portion of it. And then, like I said, there's the cash value, or like the wallet or the savings portion of it, right? This is a great alternative than having, your savings in a bank earning 0.01%. This is like your capital reserves. This is where your long-term money, this is where you want to keep this, and say like that wallet or cash value portion of your whole life insurance. Now, as you alluded to, there are other living benefits, meaning there are other ways that you can take advantage of your policy while you're alive. So there's something called an accelerated death benefit rider. This is usually offered by most insurance carriers, top carriers, for no additional cost to you, but you have this ability to be able to tap into the death benefit in your later years, or I guess it doesn't even have to be in your later years, because there's a terminal illness portion to this. So if you were diagnosed with some kind of illness or sickness, and the doctors only, estimated that you'd have 12 months or less to live, you'd be considered terminal. And if you needed to be able to tap into these funds because you needed to maybe get nursing, and assistance from a nurse, you're not able to do some of your just daily activities, washing yourself, cleaning yourself, some of those things, you might need to hire a nurse, or you might need to go to a facility. You can tap into these dollars and use part of that while you're alive to take care of the cost of some of those services. Okay. And then, just like you're alluding to, it's essentially a loan, but it just has some different tax benefits. But once you pass away, your family doesn't have to pay that back. The insurance company would just deduct those costs, or what that amount that you had outstanding, deduct it from the death benefit that they then pass on to your loved ones. Okay. Yeah. Now, there's also something called a disability waiver of premium that I always encourage people to get, especially if they're still in their 20s, 30s, 40s, even 50s, because this covers, in the event that you were to get sick, cancer, MS, just something where you might not be able to work for a certain period of time. If your income gets interrupted from a qualifying, health concern, the insurance company will take over making your premium payments for you. So they'll keep your policy in place. Your policy will continue to grow from those premium payments, and they'll do that up to a period of time. For some companies, most companies, they'll do it up to 2 years. And after that, if you're still not able to work because of whatever the health issue is, they will just essentially consider your policy paid up at that point. So it just means you won't be able to put any more additional money into it, but your cash value is still going to grow. Your death benefit's still going to grow if it's structured properly. And when I say structured properly, what I mean is, as you mentioned, most whole life insurance policies, if they're designed by, someone who's just not familiar with the strategy, they're probably just designing the policy for the death benefit. This is opposite. So this is really designing the policy for the purpose of building up cash value sooner and quicker. So It's a little bit harder to explain, but just keep it at a high level. It's a policy designed to build up, high cash values. And you want to have this with a mutual life insurance company. A mutual life insurance company is one where the policyholders are the owners. Okay. A stock insurance company is one where they have shareholders, right? So they're going to be focused on investing in things that might have a little bit more risk. They're looking on creating a return for their shareholders and then potentially paying a dividend to the policyholders. You don't want to be second. You want to be first, right? So you want to be at a mutual company that is going to be investing, conservatively, making sure their portfolio is growing so that 20, 30, 50, 80 years down the road, the money's there for your family to get the death benefit when you pass away. But that's why you want to work with certain companies that have been around. The companies I work with have been around since the 1800s. So they've proven that they, have longevity. So there's lots of different living benefits is what we call them that you can get as part of the whole life insurance.
Your whole life is going to be, that's a good question. Your whole life is your guarantee, right? You're going to average about 5% with the dividends, like guarantee it's coming regardless. The IUL, it stands for Index Universal Life. So it's tied to an index. So like the S&P 500. So let's say, and they're capped. They have a floor of 0. So you can never lose more than 0%. You just won't lose anything. But let's say the market is up 30% and your IUL is capped at 10. So you give up some of the upside to not have any of the downside, which is great, right? But there's going to be some years when you get 0. So there's going to be no growth for the year. Where your whole life is that guaranteed, but there are going to be times you get 10%. And so there's still, costs associated with it when you get those zeros. They're very flexible with premiums. So it just depends. I think that it's great, but the whole life is just, especially in an environment like now when people are seeing their 401k balances like drop by 6 figures and their stocks drop, people want guarantees, right? And one of the things you talked about is the dividend. You're not getting dividends in the IUL. So dividends are nice. And so then you're really building and growing. So
when it comes to building up the capital to be able to do something, I want to absolutely disclose that hey, if you're going to start investing or looking at securities or various types of investments, you don't want to just go out there and just do it without any knowledge, without the guide of a professional. You don't want to just because you can make some mistakes. It's definitely definitely the reality there. So you want to be intentional, either learn the right things that you need to learn on your own or work with a professional that's going to guide you in what you need to do. But it's pretty easy. For example, I always tell my clients this, hey, if you have a goal or something that you want to do, and it's 2-3 years away, great place to have that in is actually just investing it in a fixed income portfolio or a index fund. Put that in something that's going to be diversified heavily, so you're minimizing your risk. Putting it somewhere that's in the market, has various types of securities in there, and time horizon is the biggest component of this, because you want to make sure that you have the time 2-3 years at least to that money may fluctuate a bit, but if you have the time horizon on average and you're in a diversified fund, you will have more than you would if you just had that in a savings account, on average. So it's really it's about time or allocating your funds in an account based off your time horizon. But if you do that properly, it's something that when I dive deep with a client, I'm understanding what their goals are and I'm doing this, things for them. If you do that properly, it's a much more efficient place than having your money just sitting in a savings account. Frankly, I would say that if you have a goal that's less than 2 years, a savings account is a great place because it's highly liquid, it's safe. But if it's more than 2 years, you're just, losing money to inflation.
Are you enjoying this episode? Then stop what you're doing right now head over to Apple Podcasts and leave us a rating and review. It really helps our show get pushed to more people who are looking for the information that we're sharing here. We have to share the wealth. If you listen to us on YouTube, make sure you like the episode that you're listening to right now and subscribe to our channel. Then share the channel with somebody else. There are people out there looking for the information you're listening to right now. So make sure you share it with someone who you know needs it. Now, back to the show.
When it comes to forming a legacy, and that's like the third phase of wealth. So the first phase is getting a great job, getting a W-2, learning how to make money, be able to make money. And then the second phase is how to get money to work for you. And then the third phase is how to protect that and how to turn that into intergenerational legacy. Before I comment on that point, because I have some really good points about that, I do want to pause for a second and go back and remind people that when you try to go to the next phase, that is a time to be very careful about the contacts that you have and sharing those points to somebody else. Because there's this phenomenon in society that if you try to better yourself, especially better yourself from the people you're surrounded with, the people that are around you will try to drag you back down. It's like, what makes you think you can do this? Do you think you're actually going to be able to make it? And I just constantly heard that over and over and over again. And all that microaggression will start to weigh in on you. So start to curate your life and distance yourself from those negative beliefs. I remember one time I was talking to a newly accredited or almost accredited clients. And I was trying to explain to this concept that we're talking about, start to get your money to work for you. And at the time, they've done all the traditional things. There was an Asian couple, very similar to me, and their parents, similar situation. And their parents were like, oh, no, you should put all your money away into tax accounts like 401ks and IRAs, and then just keep working your job. And that was it. They felt that they had made it. And I was explaining to this whole new concept of getting money to work for you. And the wife of the couple, she looked at her husband and she said, you know what? I don't know what Ed's saying is correct. I haven't heard about this at all. It's very confusing. I just don't understand it. And I don't think it's right. And it just shocked me. And I realized it's because everybody they're listening to is either where they're at or behind them. And when I give them the actual advice, they can't realize that it's the advice that they need because they've outgrown the people that's around them. It was like, oh, I asked my mom, and my mom just kept telling me, just put all your money in your 401k and just invest and just keep working. I don't know what Ed's saying about, retire early by creating passive cash flow. Nobody does this. It's like, nobody does this because everyone you're surrounded with doesn't know how to do it.
Doesn't do it.
That's
Exactly.
why. And I was like trying to say this until I was blue in the face. It's like, you got to change your contacts, because if you stay with your contacts, you will never, it's like a fish will never grow out of that bowl. You have gotten to the maximum of this bowl. It's time for you to plunk yourself down into a bigger bowl and change your contacts. And then you'll start to be able to grow to that next phase. So it's the same thing that when we get into this passive cash flow and going and making that transition for having your money work for you and then turning into intergenerational wealth is to make sure that you can create this legacy. When we get to so I explained to my clients, when I was managing money, I would say my main goal is to be able to get passive cash flow where it meets your daily expenses. Once that does, then you're retired. You don't have to stop working, not because you have to, but because you want to.
Because you want to. Yeah.
Giving you that passive cash flow. So you have a lot of opportunities, a lot of choice. But once we get to that phase and I've now created enough cash flow for you, that lives forever. That's an engine that can continue on to send this cash flow that outlives you. And this now has the ability to start feeding future generations of your generation. Now we call that intergenerational wealth. I consider that the first phases of family office. If you've got more money than you'll ever need in your lifetime, then essentially the excess now becomes for your legacy and for the other family. So I explain to people, once you get to that phase, principal preservation becomes the main focus. So the priorities at the first phase is learn how to make a great W-2, learn how to get an increase and get promoted so I get this nice salary, or like 200, 300, whatever you get. And that's your main priority. And then after you've done that, the next is, how do I take this lump sum of my investments and do the same thing and create cash flow? That's the next phase. But then once you get to that final phase is, how do I make sure that this engine that produces cash flow never diminishes and we don't lose it, and it just keeps paying the family forever? Those are the three phases to have. And I think that a lot of communities don't have the access to this kind of knowledge and information. I got it because I was mentored by a lot of people in finance. And I was lucky to get that, but I wouldn't be able to get that advice from my parents. My parents don't even understand that. Right. So it's making sure that you have the proper advice ahead of you to get you to those phases.
I'm not look, I'm securities licensed. I think it serves a purpose, right? I think it should be a bucket. I don't think it should be the complete bucket or the entire bucket. I think where you put your money, look, you want to have liquidity, right? Meaning you want to access it when you want to access it, when you need to access it. You want to use it and you want control. And so when you have to go, I even say that for people who lock all of their money up in equity, right? Like, who's really in control? And when you think about it, you got to go to the bank and say, when you refi, you have to now prove that you can afford this new mortgage, And so it's like, who's really in control there? So I think what this environment is showing and should be teaching is I might need to do something else. I might need to diversify and not just do what everybody's doing. Should I keep my money locked up in these stocks? Should I keep it locked up in these retirement plans? And it reminds me of the crash after '08. I got into the business a little bit after that. And I remember going to see this guy. He was months away from retirement. He had lost $300,000 in his retirement account.
Wow.
He's like, now what are you going to do at 65? You're going to work 30 more years to make $300,000 back? So to answer your question, I'm not anti anything. I'm pro liquidity, use, and control. And so wherever that, and I give this example too. Like, Nicole, if you had $100,000 in your bank, you knew it was in your savings account, and you went to the bank and you said, hey, you filled out your little receipt, I want 10,000. And they say, well, if you give me 30% of that, I'll give you your 10. They might have to call security, right? It's your money and you want it now. But that's what we're doing when we're putting our money in. Like, these retirement plans are ridiculous. I got to wait until I'm 59 and a half for my money that I'm putting in faithfully. I got to get permission. You only allow certain times that I can take it out. I'm penalized if I take it out before, penalized if I don't put it back, penalized if I don't take it at 69 and a half. All these on your own, that's ridiculous. So I'm pro, we can put the money wherever you want to put it, but my goal is that you put it to grow your tree first, right?
Yeah.
Then you can take it out, jump back in the market when the market's great,
Yeah.
When it's not great, we can take it out, put it, we're just moving and kind of juggling around here, but we're not just depending on one source, one form.
There's a standard, and the most appropriate answer, it does depend on the individual person, because there's a lot of variation as to what someone's overall financial freedom age is, what types of other, goals they have. There's a lot of variation. But if I were generally, the percentage I usually telling people is a 20-60-20 approach. So, and this is for the average person that they start saving in their 20s, they want to retire, by their 60s. This is just average. 60% of your money should be allocated towards your fixed expenses. Usually your house is taking up, your house shouldn't really be more than 30%. The other 30%, other types of necessary fixed expenses. 20% should be going, towards the audience living their best life. You should also have, money out there to, live life, travel, do all those things. And then 20% should be allocated towards the future. And the one of the reasons why it's, very, in order to continue to level up, continue to go in the right trajectory, it's important to really be intentional about those allocations, is because of Parkinson's law. So you guys aren't familiar with Parkinson's law. Parkinson's law is essentially that anything that's available is going to be consumed. If we go to a restaurant, an all you can eat place, and we put a bunch of food on our plate, it doesn't matter how hungry we were, we're going to try to eat every single thing that's on that plate.
Oh my God.
So
Parkinson's law, very, very true. Go finish. Go ahead. So
the reality is what we got to do is get a smaller plate. Like if we really want to control our portions, get a smaller plate. So making that bucket smaller, because it's just human nature. Like that's what we do. It's nothing. It's not as much about discipline. It's just the fact that we are going to consume, what's available in that regard. So like we got to allocate specific amounts. So we know, all right, this is the amount of consumption I'm going to have here. I'm going to separate portion sizes. Like I'm going to do smaller plates, so on and so forth. Like, any, business that's operating, they're saying, hey, like this is the percentage that's going towards marketing. This is the percentage that's going towards, employee benefits. This is the percentage that's going towards research and development. Like they're allocating these specific things because they know that, hey, like we just have this big pool of money. It is just going to get consumed at whatever is urgent in the time.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.